All right, so this is going to be my presentation for my industry studies final. This is going to be my Excel sheet here. On the upper left corner is going to be generic information regarding the property and the values that we were kind of asked to find on the assignment sheet. So pretty generic information here is just the property address, the purchase price, the loan amount, down payment. Values are a little bit more important, which are either ones that I was asked to find or values that I use a little bit later in calculations are going to be in red here. So those would be the total investment, the principal paid down after a year, the mortgage, and the other values are here. Little notes that I want to make here is that the appraised value was a little bit lower according to Redfin than the purchase price. So a little note there. And the interest expense is going to be found here in this area, as I know I was asked to find that, but didn't find anywhere else to place it, so it just kept in this upper left corner. From there, below that, it's going to be the income on the property. Redfin did include some estimated incomes, or at least what they were charging in the past. I felt like those values were a little bit low. The reasoning is going to be on the right side here, which I took the primary variables and secondary variables predicting that are typically used to estimate rental incomes. Plus signs being, positives and negatives being negatives for affecting rent. Unit 1 I felt was really, really good as far as the size goes, the amenities that it included, and the fact that it's in the front. So I did feel as if that unit could be charging a little bit more rent. So I predicted about $3,500 a month. Unit number 2, while not quite as great considering that it is smaller and it is a back house, it's going to be lower than unit number 1. But I feel that with some renovations, which I predicted to be about $25,000, it could definitely bump that up a bit. So I feel as if 2,600 was a good amount. That would give me an income annually of about $73,000. Below that's going to be the operating expenses. So not too many here, mainly because as it's noted here, both units have separate utility meters, meaning that the tenants would be paying the utilities. So most of these values here are going to be the same ones that we've been asked to calculate throughout the year, being vacancy rate, repairs, property insurance, property tax, and management fee. The vacancy rate here is going to be 3%, 1%, and little note here being that the property insurance was actually a value given to me by Redfin, which was $50, so about $600 annually. So yeah, so biggest value here is going to be that annual expense, which is going to be about $23,000. Below that's going to be our net operating income. So that's just going to be taking our income and subtracting the expenses. So you don't take into consideration the mortgage here. Or you do take it into consideration the mortgage, it's going to be for cash flow. So that's going to be our income, and you're going to subtract both the expenses annually and the mortgage. So that value comes out to about $2,600. Cash on cash is going to be taking our, what was it here, our cash flow and then dividing it by our initial investment. So initial investment does include the down payment, the brokerage commission payment, which was 2% as stated on Redfin, and then our renovation for that back house. So yeah, that would equal about 4.01%. From there, it's going to be the gross rate multiplier, taking our purchase price and dividing it by our annual income. From there, it's going to be our ROI, which does get a little bit more technical, but it's just going to be taking our cash flow, adding on the principal that we paid down after 1 year, and dividing it by our initial investment. So ROE is pretty similar to that, except that the denominator is going to be a different value. So instead of taking our initial investment, we're going to be dividing it by our equity with no appreciation. So that's going to give us a value of 7.11%. And then ROE with 3% appreciation, exact same values, except that denominator is going to be equity with 3% appreciation given here. The calculations for each of these are as follows. You can find them by just clicking those links or tabs, I guess, technically. Below that, I included the income statement. I know technically we weren't asked to, but I just figured I'd add it on there. Underneath that, it's going to be the long-term exit strategy. This is where I want to elaborate just a little bit more, as while I feel like the cash flow is a little bit low for this property, it does have the possibility of a third unit. So the blueprints have already been created as it was stated under the Redfin description for the property, or I'm not sure if it was a third unit or an ADU. I feel like they're very similar. But point being that there's additional income that can be gained from this property. So for the long term, I plan on investing more money on the property to finish up that ADU/third unit and start getting some more revenue off the property. As far as the exit strategy, I'm planning on doing a cash out refinance, since the completion of that third unit/ADU will increase the value of the property, allowing for a greater amount of equity to be able to be taken out, and thus being able to reinvest that money into something else or another property more specifically. Property links underneath that. And yeah, that about sums it up. Thank you for your time.